to reach that point, then, you have to use some sort of unique thinking. And I think that's kind of what we all need to do at some point. Even if you're trading something that is, a tried and tested approach, you need to have that little edge to how you're applying it. And that will make all of the difference, I think.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to the Two Traders Podcast. And in this episode, Darren, we were thinking about doing something a little bit different. We're going to take this idea and talk about how that applies to your trading. So how are you today, Darren?
Yeah, I'm good. I'm actually just pulling up the definition of the word just so I know that I'm talking about the same thing you are.
Oh, good. Well, the good news is it probably doesn't matter. I mean, you can talk about what it means to you. So the idea is that we're going to talk about verification. So verification, how does verification affect your trading? And one thing that I think of when I thought of this is, well, one thing that we do as traders is we try and validate or verify that our idea is correct. So one way that you do that is you would go onto the internet and look up, whatever your idea is. So your idea might be that when the market hits a moving average, it's going to bounce off that. So it's kind of like this dynamic support and resistance level. So that could be something that you think you've observed, and you want to verify that by checking that in the market. So when it comes to trading, this idea of verification can come into play because we look to other traders or other authority figures to say, yeah, that's the right idea. And so my question is, how else is it that verification affects our trading? Because I think it does. I think it's one of those things, because let's face it, you really don't, there are rare exceptions where this has happened, but you don't go into a university or some sort of class where they teach you how to trade. Like most people, the way they learn how to trade is by bouncing ideas off other people on forums, or by reading trading books from other traders, or talking to other traders. Like, this is how they figure out trading systems and find trading systems. You don't actually go and sit down and do a 4-year degree in technical trading or whatever. Although I suppose you could argue that there are some sort of certifications and stuff along those lines. So how do we verify that what we believe is going to work in the markets is going to work? So that's one thing I think about when I think about trading and verification.
Yeah, well, I think a lot of traders do this on forums, don't they? They start a thread on a forum explaining their situation, their strategy, and they look for people to kind of say, yeah, that works, or no, it doesn't work. And I think we're kind of looking for everyone that comes along to say, yeah, great trading system, that works. I'm not 100% sure that is a good thing, though. It's difficult. Whenever I've had an idea that everyone kind of got straight away, it didn't really work for me in the end. And in fact, what's worked for me most successfully has been the one that most people say, nah, that's not going to work. You're going to lose your money. So I don't think it's always, I think how you verify it is important rather than any verification.
Okay, so let's talk about what do you do? Because I think it's an important thing. We as traders want to know or believe that what we believe is going to extract money out of the markets is going to do that. So what I would say is, and I always kind of say this, and people probably get sick of me saying this, but what I say is, look, if you want to build up the confidence in your system, it's probably a good idea to get a lot of trades in that system. And one of the easiest ways to do this, and you can debate on whether it's real or useful or whatever, I think it's extremely useful, but one of the ways you can do this is you get something like Forex Tester and some sort of trading simulator, and you go through and you trade your system historically, so you know what would have happened had you been trading it the last 12 years or whatever. So that's one thing that I say is that's sort of how you verify it. And what that will do is a couple of things. One is you'll see how it performs in many different markets, assuming, of course, that the markets have changed over the last 10 years when you did your testing. It doesn't work if you've only tested during a strong, out of control bullish trend. that would be a mistake. But The other thing is you actually get those trades under your belt. So you've actually executed the trades and you have those trades as experience. And then finally, you get some sort of confidence if you do in fact make money by doing that. And that confidence could even be in your subconscious. So it's not only in the spreadsheet that you can extract from Forex Tester and look at all your data and pat yourself on the back and say, what a great trader am I, but also it's in your subconscious, and in there, deep in there, that yeah, I can do this. So that's one way that I always kind of say, look, if you want to verify it, that's what you do. That's how you get good at this game, is you do that. But what else, what else would you say? What else can people do if it's not to ask other people and look for affirmation on a forum? Like, what do you do?
Well, I think for once I'm going to have to agree with you on the back testing, although it's not really the route I took, but I have seen a lot of traders do exactly what you say, and it's worked. And I think really what's going on there is they're verifying it for themselves. And I think that's probably the key thing. And, you notice if you give traders a system that's already been verified to work, then it doesn't necessarily work for the traders. And also, if you put a system out there and wait for everyone to agree to, you wait for the public to verify that your system's valid, then that doesn't work either. So there's something in that element, like you say, of basically going and verifying it for yourself, on your own. I think that's probably what makes it work.
Well, the other thing is, some people are listening to this and they may be thinking, well, I can just do that by running it through Strategy Tester and MetaTrader or something like that, like coding it and doing that. I don't think that's going to work for you unless you are going to allow the computer to take your trades. So if you're going to trade an EA, then that EA, that robot, if you might be able to verify that through the data that you have it spit out and say, well, it would have taken 592 trades over the last 2 years and it would have done this and this and made this amount of money. But even then, I think there's some value in actually going through and manually taking the trades so you kind of understand the logic of what's going on there. And the other thing is, a lot of traders don't do that. A lot of traders, if you talk to them, even if they're ardent robot traders, EA traders, they're coders, they believe in this, a lot of times if you really dig into it and you ask them, they will tell you that there are times when they turn off their robots. And my question has always been, if you don't turn off your robot when you're doing the strategy testing and you're having the robot take all the trades over the last 12 years, why is it that you're turning it off because the Brexit vote's coming up, or because the CPI is going to be released, or the non-farm payroll, or the interest rate announcement? Why are you turning off your robot if that's the case? Because you didn't do that when you did your testing and you got all your numbers. So that's one thing that I would say, is that it can be extremely useful to use something like Forex Tester when you're a discretionary trader. And even when you're not a discretionary trader, I think it can be useful, so you at least understand what's going on with your system, because I think that all traders are discretionary traders, even if they trade EAs, and it's up to their discretion whether the EA is turned on or off. That's always been my belief. But yeah, so there's a lot that goes on in terms of verifying your system, even if it is like a robotic, automated system.
Yeah, there's definitely something in there about physically taking the trades yourself rather than running them on an EA. It's quite funny what you say, actually. I was listening to a guy this week who did exactly what you said, and he basically has been trading this manual system, and he had a very bad loss this week. So he was talking about his loss, and he was saying that he's dealt with it, and now he's programmed an EA to trade the system. And he showed us all his backtest results, and they were, obviously, it was just a beautiful smooth equity curve going, up in a diagonal line. It was the perfect system. And then he said that, he was going to switch it off and on. And, I posed the question to him, is that, why are you switching it off and on? And he said, well, because the market might, certain events in the market will be coming up. And I thought, well, how can you consider that data is valid, but then at the same time say that you're not going to go with it? And I find that all the time. There's that kind of conflict in what traders might be saying, and they don't see it. To me, it's really sort of, obviously it's an outside party. To me, it's really obvious. Then, if you're gonna mess with the EA, then there's obviously something in your mind that says there's a problem with these results. Otherwise, you'd switch it on and let it run, wouldn't you?
Exactly. Yeah, that's exactly it. I mean, sometimes it just takes an outside perspective, and sometimes you can get that from somebody who's not a trader. You can just have someone who is not a trader. You can explain everything you're going to do and show them all your data and everything, and sometimes you'll get these questions, and you don't consider the fact that you've built this beautiful equity curve, and then you're going to mess with it in the future because, of course, you know better. So, yeah, it's crazy, but I suppose it happens.
When you're trading something manually, is the kind of like a ballpark figure of how long or how many trades you should take before you can consider, your system verified? Is the kind of like a number or a time that we could agree on where you can say, I've given this system enough time to know fairly confidently that it's the results are going to replicate going forward? Or does that vary completely for every system?
Yeah, people throw out things like 30 trades or 100 trades, and there are formulas that are based on all that, at least 100 trades, plop your numbers into this formula and all that. But what I've found is I think that it's depending on the system. So I'll give you an example. So if I've got some sort of reversion to the mean type system, I can probably have a pretty good idea over 100 trades what my average trade is going to look like. And what I mean by average trade is how much money does your average trade make based on all the winners and all the losers. You add it all up, and then you find out what that average trade is. And also, what's your average loser going to look like and all that. But the other piece of this is, what if you trade a system? And the reason why I use the reversion of the mean system is because those are pretty consistent in that, you're either gonna try and catch a trade when the market's taking off in a trend, which means you're gonna get stopped out, or you're gonna catch the market reverting to the mean, and then you're gonna make money or break even or something not quite as bad as getting stopped out. But here's the thing: if you're trading a system where you really need to have those fat tails, as they call them, or those outliers, which is really kind of related to, like, if you have any sort of a trailing exit or some sort of really aggressive target like 20-1 or something like that, you're probably going to need to have more trades in your sample to have a good idea of what's going to happen. And you can see this in the equity curve. Okay, so if your equity curve is, generally speaking, it looks like it'll shoot straight up, and then it'll kind of plateau and go down for a little bit, and then shoot straight up. So it makes those really strong jags up, and then it kind of goes down for, kind of drifts around and sort of flags down for a bit, and then shoots up again. Then you probably are trading one of those systems where you need those really big outlier type trades to make it work. And if you don't take enough trades in your backtest, you won't catch enough of those to really understand, what's likely. So, for example, let's say that you, on your equity curve, you see the market shoot up, and then it kind of just sags down and flags down, and it never shoots up again. Well, that probably means that you only have a handful, or maybe even one, of those really big fat winners that you're counting on, and then the rest of your trades are basically losers. And so you end up and you go, well, this isn't very good. This system's not very good at all. It didn't make much money at all. Well, if you had gone through and taken another 500 trades, you'd probably see another, 5 or 6 of those really strong winners that makes it all worth it. So to me, it depends on the system. That's my point of view. I think that some systems depend on outlier trades more than others. And if you see that in your equity curve, where you see these really drastic steps up, then that means that you're relying heavily on those outlier type trades. So that's what I would say. But I suppose everyone's, got their own perspective there.
And I'm definitely going to agree with you here. When the risk to reward and win rate is skewed massively, you need a much bigger sample. And the one that I see much more often is basically the opposite of what you were just saying there, where this person has like a very, very high win rate and they're all very small wins. and you look at his equity curve for 6 months, and it's just steadily going up. And then he has one loss, which takes away half of his profit over the 6 months in that one loss. And I see loads of those, as often with EAs. And, the danger with them, if you use too small a data to work it out, it seems like you've got the perfect system. You risk too much, and then that one loss completely wipes you out. And I see those kind of curves all of the time, and it seems like that's a trap that many people fall into, that style of trading. It might be where they're trading without a stop loss as well, and they're just, the trade always comes back until the one that doesn't, and that one that doesn't completely wipes you out. So yeah, I think if you're trading those extremes of risk to reward, you need much bigger data to work it out on.
Yeah, and I think the classic example of what you were talking about is the Martingale. And most traders come upon this idea when they get into trading, which is, you have a loser, you lose $20, so the next trade you go for 40. You lose 40, you go for 80 and 160 and 320 and so forth, until you get your money back eventually. And people have talked about this with gambling and everything. The point, I think that's where it came from the gambling world. But the point is, if you do that, you will see an equity curve exactly like what Darren just described, which is you will see a steady up, and then it'll fall off the cliff. And so here's one way to see whether or not your system is going to be running into this issue. What you do is, for whatever data you have, your live trades, your back-tested trades, get all of the sum up all of your winners. So flag all your winners in a spreadsheet or whatever, add them up, and then divide those winners, that pile of winners, by your largest loser. So it's a real simple formula. And what you will find is, if your system is crap, sorry to break the news, but if your system is crap, what will happen is you will have a number less than 6. Now, 6 is kind of like the bottom, like, to me, 6 is like the bottom of the line, like, just barely scrapes it by as a verified system, we'll call it. We're talking about verification. But if, ideally you'll have 10 or something, or greater than that, 30 or something like that. But if your number is 3, okay, so in other words, what that's saying is that your largest loser is taking out 33% of all of your winners. We're not even talking about the other losers. We're just talking about the largest loser, right? Then you have some sort of Martingale type system that's going on here, and your reward to risk is just way off. So I know this is kind of a simplified way of doing it, but for a lot of people, this is going to be a very useful thing to do. And what you want to do, again, is get that number over 6. Because if it's anywhere below that, you're in big trouble. And you're going to have an equity curve like Darren was talking about. You're going to have this Martingale style of drop-off, which is just horrifying when you experience it live. So definitely try and keep an eye on that number. That would be my advice to people listening to this.
It's amazing how popular those styles of trading are. I never really noticed it before, but I use my FX book sometimes to look at other traders and strategy performance, and you see so many of these. And, I can understand why it's popular. We don't want to go through those that, constantly giving money back and, win some, lose some. That is really part and parcel of trading successfully. And we all want to avoid that. Loss aversion is strong in all of us, but I never realised how popular it is and how people get hooked into it so quickly. And, you can have a trader put together a really amazing 6, 8, 9 months of trading that looks like the perfect system and unless you know how to kind of dig deep into the numbers, it's very convincing. But I'm sure a lot of people lose their money going down this route.
Yeah, and I remember when I first found trading forums, there was it wasn't even really a Forex forum, but there were enough Forex traders that there were like little sort of subdivisions in these stock trader forums. And there was a guy who was really he was very sort of he divided the crowd. So you would have these people in there who were talking about this guy, and he was kind of like he's kind of like an internet rock star, right? And he would occasionally he'd get banned from the forum, and then he'd come back, and then under a different name and all that stuff. It was so funny, but his whole thing was basically based on the Martingale, and he was saying, like, look, if you have such a large account that you can keep, taking these really small trades, you're going to survive, and he was like, he had this big story about how he learned it from some rich guy in China or whatever, all this stuff. I mean, it was hilarious. But the point is, just like, and don't take my advice. Go ahead and test this out yourself. But if you look at these equity curves, what you'll find is some of them will get really lucky, and they'll go on for thousands of trades. But eventually, the Martingale system fails, because eventually you'll just get a losing streak that you can't recover from. So the beauty of it is it's so simple, isn't it? Such a simple idea. Why not just do this? And it feeds right into our biases, like you say, Darren. It feeds right into this need to win. We have this strong need to win. It's the reason why, these really valuable, profitable trading systems that don't win that often are so difficult for so many people to trade over the long term, because of the need to win. And then you need to be right. You need to say, yeah, I did good. and that's one of the things I think traders we have to be aware of, is that you can feel like you're verifying your system because you're winning, but in actuality, a lot of these systems that have a really, really high win rate are terrible at growing your account, and will just send you into the poorhouse. So it's something to be aware of.
Yeah, I think it's where that saying of cutting your losers short. And I look at a lot of them, and I think, if you just took a few more losses, if you just were able to limit those losses by half as much, then, you've got a good system here. But that kind of really high win rate takes over as being the most important thing, and it eventually becomes their downfall. And I do know some traders that go down this route of kind of having a skewed risk to reward and having small winners and relatively large losers. But what they're really good at is having their threshold for the losses, and when it gets to that threshold, they cut them short. And the people that come unstuck, they think that it's always going to come back, and that never happens.
Yeah, exactly. Yeah. So when we're talking about verification, there's a couple of things I suppose that I'm thinking of. Verify your system by trading it in a simulator like Forex Tester. Verify your system by making sure that your winners are not dwarfing your losers by using that formula that I gave you. And if you're like Darren and you're contrarian, I'm quite contrarian too. I like to see what other people are talking about in the business papers and on the TV, on the business channels and things like that. And the reason why is because I want to know where all the losers are gathering. You know what I mean? Like, I want to know where's everyone sort of going to lose their money next. And so I pay attention to what the crowd's doing. These are the sorts of things that you can use if they fit with your personality. And verify, with the number of trades you take. Make sure that the number of trades you take in your simulator fits the style of trading you do. If you're a trader who depends on those really big winners, then you have to take more of those. And I know I've told this story before, but for those people that haven't heard it, I think it's worth repeating, because it kind of fits with what you just said, Darren, which is this idea of, if you just were able to cut your losers a little bit, if you cut those in half, you would have such a different system. And how all these traders are so interested in Martingale style of trading. I had a friend who started a fund, and he brought these traders in, and he told them that if they could do well, they'd trade live money, but in the meantime, they'd have to trade this demo account. Now, I know there's all kinds of moral dilemmas with this situation, but this is the reality of what he did. He took these traders in, and they had this platform. They couldn't really change the position size, so they didn't know how much they were trading, and it was a demo account anyway, they thought. But it was actually a live account, and what the system would do is it would custom programmed platform that they created for this, and it would flip their trade. So if they went long the euro, they would actually be shorting the euro, and it was connected to the fund's money. So it was actually a live account. And so what was happening is he was bringing all these traders in, and occasionally he'd get a trader that would win, and occasionally he'd have to move them up to a quote live account. But most of the time, they would make a whole lot of money from the losing traders, because they were, of course, cutting their winners short and letting their losers run. I mean, it sounds silly, but it's exactly what most traders do. And so his big deal was trying to make sure that these guys stayed motivated, because they were getting down on themselves, feeling like, I'm never going to qualify for the fund. And they would just be like, no, you can do it. Keep going, because they were trying to keep these guys in the game, because, of course, these guys were making the money for them. So I know it's crazy, but it's true. And it just shows you how so many of us are not born to do this. It's such a difficult thing to learn, because we want to cut our winners short and let our losers run. But it's true. Yeah,
and it also proves the point that, your edge in the market is not going to be something that's already out there. It's going to be from you thinking outside the box and being a bit smart. And obviously now it sounds obvious. Okay, well, if all new traders tend to lose, then all you need to do is set an EA up that reverses their position. Sounds obvious, but to reach that point, then you have to use some sort of unique thinking. And I think that's kind of what we all need to do at some point. Even if you're trading something that is, a tried and tested approach, you need to have that little edge to how you're applying it, and that will make all of the difference, I think.
Well, that's great. That's great, Darren. Thanks so much for your time, and we'll see you in the next episode.
Okay, cheerio, Walter.